Hello, YouTube. Welcome back to the Wolf Catchers YouTube channel. Glad that you guys could stop by and check in on it. So, just want to say thank you to everyone who watched the first video and got to learn a bit about what we're about here. I do appreciate the subs. Do appreciate the comments. So, just every time you come by, leave a comment, you can like, subscribe, give me some ideas, more topics to talk about. So, this video right here is going to be about weekly outlook for what's coming up. It's kind of late when I'm putting this up. I just randomly thought like, hey, it's Sunday night. Let me just with a quick video put out there so we can see what to expect for the week ahead. So I got some good information here to share with you guys. So let's dive into it. So what we going on for the week? We have some kind of mixed market sentiment. So I see up there at the top, I have the futures. So the futures markets is like a secondary market that's going on their own type of time schedule. So we have the stock market that's open 9:30 to 4 p.m. Futures usually starts later in the night, and then on Sunday night, I forgot what time it usually kicks in. You can start seeing it. I think it's like 8 p.m. or 6 p.m. You start seeing how excuse me, start seeing how stuff are being traded, and usually it's a good indicator of what's gonna happen for the next day following. So you can see here that we have some green across the board for the Dow, for the S&P, and for the Nasdaq. It's nothing too crazy, nothing like super high, but it is some green. And then if you paid attention to what happened last week, you saw our fear and greed index for the stock market over here with the 22. That would put us in extreme fear. Then we have the crypto market. They had a rating of 17. And then you see their historical values the day before. They had on 18 last week. They were at 29. Last month 28. And then you can see here the last time they were at extreme fear was a 15, and that was back in March. So we have all those type of feelings going on in the market. So we have futures is on the upside after we just left the week where everything is pretty much in extreme fear. So there's some type of divergent there going on where things are kind of mixed, right? So things that could be leading to this type of investor sentiment, why people are feeling this type of way. We gotta remember we have lagging economic data, so that has some heightened investor caution. Government shutdown just ended, so during the shutdown we weren't getting any official jobs report, no CPI data, things of that nature to help people make better informed decisions about what's going on in the economy. All those type of things were pretty much not released. No one was working on it. So people were moving and investing and doing things like in the fog, I like to say. There's nothing clear cut. And then if this pretty much pertains to probably like institutions, things like that. I think the everyday person who's trading and who's investing, it is important to know those data points and stuff like that. But over the long term, did it really have an impact? I personally don't think so. If you have a decade horizon of investing, I don't think that pretty much matters so much. But some people, you have a 3 6 month trade you're trying to worry about, or you got position, options trading, things like that. Those type of data points will affect your trade depending on when it comes out, how bad it is, month over month, year over year, those type of things. Excuse me. So then, second thing, we have the talks of an AI bubble. You've seen it everywhere, whether it was on Instagram, it could be TikTok, it could be any social media outlet, YouTube, CNBC, Yahoo Finance, Bloomberg. Everyone's talking about an AI bubble. AI bubble. It's just everywhere. You can't escape it. So the talks of that is also raising some fear and some concern. People are really concerned about what is going to happen, especially when companies are coming out saying they're spending all this money on CapEx. And the big thing with the AI trade is people are fixated on when is it going to yield a return, right? So you pouring all this money into it. Then you saw what happened to Meta a few weeks back. their stock got crushed. I think they're trading now below 600. They were closer to about high sevens, 800 almost, and then they got decimated when they said, "Hey, we're going to be spending more on capex." So they got crushed. So it's those type of things where people are they aren't. I shouldn't say investors aren't mad about the spin. It's more so, is this going to work out, or don't you think you're spending too much? Take it down a little bit and let's see if this actually is worth it, right? So we have that, and then you have some names. Michael Burry. He's from the Big Short. He's the guy that called the 2008 market crash, the great financial crisis that happened with the mortgage and mortgage-backed securities and all that. So he's a market mover. If people don't probably like that term or not, but he's someone. His word carries weight because he was proven in this super huge moment. So whenever he posts something, he says something, people kind of follow, listen to what he says. He's revealed some positions that he has, some puts against companies, I think like Nvidia, Palantir, that he's betting against them, right? And he is someone too that's sounding the alarm on this AI bubble. He's someone that brought up the how these companies are putting depreciation on these GPUs and these chips, and then kind of like saying it's like some type of financial engineering going on because they're depreciating them at a different timetable than what they're used to be. So you could dive more into that. I think there's some articles online about it. But like GPUs have a certain depreciation that they already had set, and now people are changing around. These companies are changing the depreciation length window now, and that's affecting the bottom line now to make their numbers look better. So even that may be true, probably something small, but it is enough to bring up what's going on over here. So he's someone that's definitely looking into that and sounding the alarm on stuff like that. So again, he's someone big name, carries a lot of weight. He is, in my opinion, always a bear. So he is very negative about certain stuff. I feel like he's always looking for something to break down. And I'm on both sides of the coin all the time. A bear is always going to be right at some point, and then a bull is going to be right. That's the market. We're going to have ups and downs, and it's the nature of it. We need downs to get people and investors. We want great opportunities to get good positions to invest in and all that. If it's always going up, you're always chasing the high. Me, I don't want to chase a high. I don't want to buy at a high. I want to buy at a good discount, 10, 20% off. Treat it like you buying your favorite pair of Nikes that just got a clearance on them. That's how you got to look at these opportunities, right? So then we also got the consumer who's showing some signs of weakness. If you're paying attention to how the market's going, it's going pretty bad. Like the economy, I should say, not the market. It's going pretty bad. Like we have a lot of jobs being lost, a lot of people out of work, and then we seen again with the government shutdown, like people weren't getting their checks. So all these things are trickling and pouring into each other, and then I like to call it's like cracks in the bull, right? There's cracks in the economy, and then if you pay attention to what's going on, it's like a K-shaped recovery, right? The economy with the everyday person is going down, stock market and the stock market is going up. So it's a K-shaped recovery, right? They are completely a mind of their own, doing their own thing. On one side, economy is doing terrible, stock market is doing great, right? For the most part, right? Because we had the record highs this year and all that stuff, right? So, and the top earners are the ones that are really holding up the economy because they're doing the majority of the spending. So, our middle class and lower class folks, they're not really putting enough income out there to produce or do enough spending to keep the economy propped up. So it's a lot of the top earners. And with data for the most part, right, from articles I've read and stuff like that, when the stock market is going high and people 401ks are looking beautiful, the brokerage accounts are looking great, hitting all-time highs, everything's just clicking. It's like I can't do no wrong. You're in a feel good mood. You're gonna tend to spend more. If my 401k, in the past quarter moved 20%, and I gained $5,000, $10,000 in it, it's not gonna be a big deal for me to spend an extra K this month or something else. or if my taxable brokerage account, got I'm up 40% on the year to date. Like you're gonna feel in a good mood. You might sell some stuff off and go, spend some money on something you wouldn't have bought before. But now if we start to have these sell-offs going on, those same people who are spending, they're gonna start seeing, their accounts go down 5% in a week, 10% in a month. They're not gonna be so willing to go spend because now, hold up, my 401k is down a lot. Hold up, my taxable brokerage account's going down, my Roth's going down. So those same um, top earners that were doing the heavy spending, if their retirement accounts and all their other accounts are starting to go down, they're going to par back. And I think that's when really you're going to see how bad we're hurting in the economy. So for the last one, market uncertainties are prompting a wait and see approach among investors. And then I put in there as well, Fed not cutting, right? So we are in a wait and see. We have some things going on. I'll have NVIDIA in here later on. So we're in a moment of time where it's like there's this indecisiveness, there's this worry, there's uncertainty. And again, the wait and see approach. Fed has come out for the most part. It's hinting that they're not going to cut rates in December. That comes to be true. It's definitely not going to look good because not cutting rates and everyone wants rate cuts, right? And for them not to cut it, which is again what it seems like they're leaning to, it's not going to be a good look. So adding on to this weakness we had from last week, so a lot of it was obviously tech focused. So me personally, I am a tech enthusiast. I'm a strong believer in tech stocks. My portfolio concentration is in tech. So anything from my son's account, tech, my siblings' account, tech focus. That's like the concentration. I do have a good foundation built with them with FNILX, which is the kind of like the Fidelity version of I think a large cap growth. I want to say if I remember correctly. So they have some quote unquote diversification in there, but obviously the top leaders inside that fund are tech stocks. So very well exposed to tech. So this XOK is one of the spider ETFs that tracks the tech sector. They're down 2.5% last week, so definitely felt that across all the accounts. And yeah, so tech played a big factor in the market sell off. Um, had a lot of big names underperform, and we saw some names like Palantir, Nvidia, and the semiconductor. The ETF I like for that is SMH. All take a nice big hit. Palantir has some great earnings, still sold off. So that's where it is. It's like you could have your earnings, you could have this and that, everything going right on paper, still going to sell you off. So that's where we're at right now. We're just in the people are finding a reason to sell, right? And then some causes of the tech sector weakness, obviously valuation, right? So these stocks that ran up so high, like the things aren't correlating, it's not making sense anymore. You got the price to earnings for some companies, like I think Palantir at one point was like 400, 500 PE ratio, right? So it's not making sense. So some of these valuations are getting so out of whack that people are saying, no, there's something wrong. And then which leads to a second point, profit taking. People who have been in these trades, people who have been invested, roll these guys up and then they're like, okay, cool, had fun. Let me sell some stock off. Let me trim. Let me cut some off the table. And then it's profit taking. Because if you had something like had a position for my little brother in Roblox, it wasn't a big position, but it ran up like crazy. I think we got in like at 30 and change, and I think it ran up, I think, to over $90, I think, per share or $100 per share, whatever number it ran up to. For me, that's a speculative investment. It was just like oh, he plays Roblox, just buy some stock in it. When it ran up like that, it's like, okay, cool. Let me take some off the table for him and we roll it into a a more stable name, something like a Microsoft or Eli Lilly or something that I feel more better about him holding long term. So those type of things, like someone who held Palantir under $30 and then got to the hundreds or whatever was the high 100s or mid 100s. Yeah, they're going to sell. So that's where it is. It's like the high tech valuations, profit taking. It's definitely going to lead to some more weakness in the tech sector. And then we have Nvidia this week, right? So November 19th, they're going to do their earnings. And this is a big catalyst for the market because if you pay attention to the market, right? Nvidia is always a highlight whenever they're about to do earnings. They're like, it's like the Super Bowl for the market. They're waiting to see what Nvidia says. What's the guidance going to be? Like the revenue growth, profitability, all that's cool. But what's the guidance? What do y'all see that's going to be happening? What do you foresee coming down the pipeline? Is this AI trend still going to be going on? Because Nvidia carries so much weight in what they do, they basically set the pace for everything else. If they're still getting inflow for a ton of orders, if they still have a backlog of customers and all these things that are keeping them like, yo, we have so much we got to produce, then it solidifies the AI trend story, right? But Nvidia shows even just a bit of slowdown in growth, a bit of slowdown in sales, people are going to take that and be like, the market's falling apart. The AI trend is over because people aren't buying chips, this and that. But my take on that is at some point, it is going to slow down. At some point, all these data centers are going to have the chips they need. All these companies are going to have the stuff they need. And also, too, NVIDIA is going to be too expensive for them. NVIDIA, to buy some chips from them, it's pretty pricey. Not every company has the type of money to buy and invest in their data centers with NVIDIA chips, which is why I have a number two player like AMD. Again, back to what I said in my first video, you get the one and two player in the space. NVIDIA's number one, AMD's number two. So companies are gonna go down for that lower price point for what AMD has. Still good quality, still get the output that they need, and then buy through them. So Nvidia is setting the pace, but they're one of those companies where if their earnings don't give people what they want to see, investors what they want to see, the sell-off could be tremendous because they could beat earnings, do everything right, but what they say in guidance, excuse me, is what they say in guidance is what's really going to determine, I say for sure, for how the rest of this year pans out and going into the next quarter, beginning of next year. So they're definitely going to set the bar for what the rest of this year is going to end and how we pivot into next year. So just to highlight some of their market leadership, right? So their earnings again impacts broader market trends. So something happens with Nvidia, then other sectors, other industries are going to start getting affected because, as you know, everyone's trying to get AI implemented some way, somehow into their business. But if Nvidia is showing some cracks, showing some weakness, it's going to be like a contagion effect. Everyone's going to start getting affected, right? Then everyone sees that, leads to our next point: investor sentiment. People start thinking that the businesses from their side of view, right, the B2B side, start seeing, oh man, something's going on with Nvidia. Are we doing the right thing? Then investors are going to start questioning too. Do I have to sell this off, right? So it's going to start becoming this wall of worry for everybody. Then Nvidia leads tech. They lead the semiconductors. They fall. The rest of those tech sector is going to fall. The rest of the semiconductors are going to fall. And it just becomes this domino downhill effect of everything happening. And then how the broad market's going to react is definitely going to shape how future investments are going to play out. Then it's going to be more fear put into questioning, will X, Y, and Z go back to leadership? Will this work out now because that didn't work out then? So it's going to be all those things. They falter is going to lead to a lot more questions than answers, right? And then you have your bulls like Tom Lee, your bulls like Dan Ives, who, I always say we're right in the beginning of this. We're right, the party just started for it. But I feel like how investors are looking at it and all these All the folks that are involved, how they're looking at it, they want like to be 100% sure. I think every quarter, every month, this is the right thing. This is the right thing. No one's thinking, I guess, long term for it, which is what leads to the short term volatility. Me personally, 5 years from now, Nvidia will be fine. The AI trade will be fine. But people aren't looking at it as a 5 year, 10 year, 15-year process. They're looking at it as what is going to happen tomorrow. That's what I care about. So then back to another thing, like the Fed, right? So they have their Fed meeting on December 9th and the 10th. So that's next month. So that's when they're going to determine if they're going to be cutting rates or not. So just some information about the Fed. So they're the ones that control monetary policy to a degree, right? So they set the Fed fund rate. So that's the rate that banks could do overnight lending to each other. So they have their own rates that they lend money to one another for reserves and liquidity and all that stuff. So when the Fed sets those benchmark rates, it affects the banks, which then in turn affect us as consumers. So those rates affect our consumer loans, that affects our credit cards, that affects if you're able to get a personal line of credit, what rate you're getting charged at, things of those nature, right? So higher rates, the liquidity usually tightens up. It's usually harder to get a loan. Money doesn't flow as easily, and money's more expensive. So when like rates get lower, money is less expensive. It's easier to go get a loan. It's easier, to get money moving around. So it's a double-edged sword. Some people be like, I want rates to cut. I want rates to cut. But the Fed has, that dual mandate where they want, low unemployment and they want stabilized prices, right? And all that stuff. So cut rates too much, then there's too much liquidity in the market. Money's too cheap to get. Then things get overinflated, right? Which happened, last time, which is why we had interest rates of like 9%. And then if you keep rates too high, then it gets too tough for people to actually get the loans that they probably need, get the money and access that they actually need to make ends meet and things of those nature. So it's a tough line to balance. It's a tough thing to balance. And what people don't understand too, when these rates get lowered, it also affects your savings rates in your bank. So your high yield savings account gets affected. Right now, you're probably getting a 3%, 4% in your high yield savings account. They keep cutting rates, then eventually your bank account is going to be giving you 2% in your high yield savings account, maybe 1%. When you're going to look at that, that's the whole point of it, is to encourage you to see, hey, your high yield savings account rate is showing you 2%. How about you take that money out, go buy some bonds that can get you 4 or 5%, or go put it in the market, get you a nice little 8%, 10% return for some more risk, right? People are going to be more inclined to do that, which then in turn gets money moving around, right? That's the whole point of it, to get money moving around, money stimulating the economy, right? So the rate decision is pretty important. It helps small cap companies, helps companies like in the Russell 2000 because money's cheaper for them to get. Helps them be able to get loans so they could, do R&D investments, help their businesses grow, their companies grow. So rate cuts is a somewhat growth indicator. It helps businesses, investors get money moving to grow and push forward, right? If it's done correctly. So just to wrap up what we talked right about on this video, current market sentiment, we see there's some confusion or a little indecisiveness. Futures are up, but from last week, what we saw, it's not looking good. Fear and greed index for both crypto and for the stock market, definitely not looking good. We had extreme fear, and we're still near all-time highs, except for crypto. Crypto's, I think, Bitcoin's now like 96,000, I think, today. But the stock market is still near all-time highs. It's not. I don't think you see it's not even more than 5% from the high. It's nothing crazy. It's probably like a 2-3% drop. And then Again, tech sector weakness, went over that, was leading to it. Um, we got the Nvidia saving the market. That's what the hope is this week for a lot of people. Nvidia comes in with some good news, some great guidance that saves the market, leads into that Santa Claus rally. We'll see if that happens. Me personally, I'm not uh, hedging too much on that bet. Just it is what it is. I would definitely, like I said, a long term view of everything. Whatever happens, happens. I'm thinking 10 years down the line, 15 years down the line, but I'm taking advantage of short term volatility because volatility gives you great prices. That's what you have to look at. You don't have to look at, oh no, it's tanking right now. You got to look at it as like it's tanking, what's on sale, what can I take advantage of, right? Because the prices you see this year, hopefully 5 years from now, it's going to be double that. That's how you got to think of it, right? And then the last thing, Fed might not cut. That's probably a very high probability they're not going to cut rates. So again, pairing Nvidia not having good earnings, or I should say good guidance given, and the Fed not cutting, the end of the year is not going to be too hot for the stock market if those two things happen, right? So I thank you all for stopping by, spending some time listening to me talk about my thoughts and everything on the market. Again, contact info is here. You get feel free to send me an email. Visit the website. Got some articles on there. I got my watch list over there. Got some SWOT analysis stuff on there about companies I break down. So feel free to go over there, check out the blog, and then don't forget, catch and secure your wealth. Thank you guys for checking in. See y'all next time. Peace.